Hey, what's up you guys, it's Adri here, welcome back to my channel. I know I posted my last video quite a long time ago, but it was an insanely busy period for me and I'm sorry for that, but I will make up for you by posting a video every single day this week. So that's my promise for you. I hope that I can keep it and I'm going to try hard to do that. With that said, I'm going to introduce the new subject of today, and that's CFDs, contracts for difference, because we all know how the GameStop scandal went. Basically, hedge funds in the USA lost around $19 billion and they set to manipulate the market. And after that, many investors lost because they went into FOMO buying, and online brokerages such as Robinhood stopped orders and letting their investors to trade GameStop shares, even shares. So we are not talking about a contract for difference here, which should not be allowed. In fact, I am against that. Since I invest in your platform, those are my money, so I should be allowed to do whatever I want with those money, right? Just let me know what you think in the commentaries. Anyway, I think that it's still risky, especially when such a scandal occurs. But since we don't have legislation in place, you're free to do whatever you want with your money. And you shouldn't be the subject of a brokerage to control your money. That's just my opinion. So let's see what CFDs are and what the risks are. A contract for difference is a derivative because you don't actually own the share or the stock. You actually have a contractual right, and of course you have also contractual obligations with regards to a share or a bunch of shares. It depends on the contract, but usually it's about a share. So a CFD allows you as an investor or a trader mostly to trade the difference of a contract between the opening time of the contract and the closure of time on a short term. So you're not going to do a contract for difference for, let's say, months. You're going to do it usually for up to 36 hours. It depends on the platform. Usually most platforms stop a contract for difference in less than 24 hours, so like 23 hours 59 minutes, which is why it's risky, because we are going to discuss about volatility and the lack of legislation in this field. We see here that most of these online brokerages such as eToro, Robinhood, Plus 500 and many others, trading to 212, many on short, let you know in advance, because this is the law, that around 84%, some platforms say that even 94% of the traders lose their money. So you have a high risk of losing your money because they are highly volatile and there is low liquidity here. And you're exposed to news. You have to follow this news every single day. Whereas for long-term investors, daily news just don't matter. That's the reality. So let's see how these CFDs work. Let's say you bought a share, but not a share, a contract for difference of that share for $100. And you speculate, because this is the key term for CFDs, to rise in price, let's say, around 50%. So let's say by the end of the contract or before it, is going to be valued that share that you don't own, but you have a contract to buy at the initial price of 100 and sell it to your buyer. Actually the platform's buyer, but let's keep it simple. You're the one who's going to trade that contract for difference, and you're going to gain the difference between the selling and the buying price. Here, what's important is that you simply expose yourself to risks such as market risks, client money risks, and liquidity risks and gapping, which are the main concerns for day traders, especially when we talk about derivatives. The prerequisites to trade such CFDs, which are very risky in my opinion, are the followings. You have to be an elite trader first. You have to understand economics, basic economics very well, and develop your own strategy coming from that. Have the knowledge to conduct strong fundamental analysis for that respective industry sector. And besides that, you really have to know your technical analysis, because it's the fundamental key to success here. Without knowing the patterns of the chart, you're going to be simply screwed. I mean, that's the reality. That's why around 90% of people lose their money, because the remaining percentage are the winners and the rest are the losers. Because like in every war, this is what day trading is a war. There are winners and losers, and winners are less. Think about World War II. There were a handful of countries that won that. Besides that, you have to have discipline while trading, because you need to maintain your emotions under control. You have to do cold trading here, just rational decisions. If you lose, that's it, you move on, you go to the next trade. This is how elite traders do. You can't win every bet. You just have to keep going, because sometimes some other parties are better than you. They just anticipate the market movement better than you, and that's normal. Even the most advanced computer would fail sometimes, right? And I think that the last one is the most important one. You have to have risk management. You really have to know what you are supposed to lose every day, and if you touch that threshold, you stop trading. You move on. It's a lost day. You regain your powers and prepare better for the next day. That's how you do that. Don't undergo revenge trading, because that's what actually happened with the GameStop scandal. Hedge funds lost, and they said, okay, we know how to recover our money, so let's go with Reddit and manipulate the market. Yeah, and they did it amazingly well, apparently, right? Simply said, CFDs are way too risky for an average trader or investor. And according to a 2011 study that underwent investigation into the portfolios of 6,500 traders between 1991 and 1995, those buy and hold investors outperformed with less activity, around 20% from what I remember. They outperformed the more active traders, the day traders basically, with somewhere around 7+%. So $1,000, according to that study, invested in 91 would have been valued at around $2,970 for those long-term investors, the buy and holders, while the other type, the active traders, would have earned just around $1,900 for an initial investment of $1,000, which shows us that long-term investing is better because, as Warren Buffett says and many other great investors of our time, so it's not just me here, I'm calling to authority, which is a logical error maybe, but it's the truth for this case. Timing the market beats timing the market. You just have to remember that. But you do you, I do me. With that said, I'm going to prepare a dividend investing strategy video for tomorrow. So make sure to watch that, because you might be interested into dividend investing, because there are many perks coming with that strategy. So just click the notification and please subscribe and smash the like button because it helps the algorithm. And if you found something interesting in this video, by just subscribing and liking this video, it will let me know that I'm on the good path. So thank you so much for watching, and till the next time, guys.